Before we get into today's briefing, and I promise you, what we are covering today is genuinely important, I want to be upfront with you from the very first second. Everything I share in this video is purely for educational and informational purposes. I'm a market analyst and educator. I'm not your financial advisor, and nothing in this video should be taken as a recommendation to buy, sell, or hold any asset. Please consult a certified financial professional before making any investment decisions. I say this not because I have to. I say it because I genuinely respect your money and your future. Now, with that said, let's get into one of the most important gold market stories of this entire decade. Something extraordinary is happening in the gold market right now. And if you blink, you're going to miss the most important financial story of this decade. I'm not here to sell you anything. I'm not here to hype you up with empty predictions. I'm here to walk you through the cold, hard data, the real geopolitical developments, and the structural forces that are quietly reshaping the entire global monetary system. Forces that are keeping gold elevated even when every classical economic rule says it should be falling. Welcome back to John Ag Briefing. My name is John, and today we're going deep. We are covering the latest U.S. Consumer Price Index numbers, the most recent jobs report out of Washington, the critical outcomes of the G7 summit, and most importantly, why gold is sitting comfortably in the $3,975 to $4,040 range per ounce as of today, June 24th, 2026, despite every traditional signal telling institutional investors to dump it. If you have ever wondered why the old economic playbook seems completely broken, today's video is going to answer that question for you in full detail. So grab a coffee, settle in, and let's get into the data. Let's start with where gold actually stands today, because the numbers are genuinely historic. According to live data from CNBC, Trading Economics, and JM Bullion, gold spot price is currently trading between $3,175 and $4,040 per ounce. Just 24 hours ago, it was touching $4,113. Now, some of you watching this might see that slight pullback and feel nervous. That is completely understandable. But here is what separates informed investors from reactive ones. A single-day dip of 2 to 3% inside a multi-year bull market is not a warning signal. It is a buying opportunity, or at the very minimum, a moment to hold steady and understand the bigger picture. And the bigger picture is this. Gold is sitting approximately 20% higher than it was just 1 year ago. 20%. Think about that for a moment. Now, here's a number that a lot of people in this space still talk about. $2,085. For years, that price level was an impenetrable wall. Every single time gold approached that zone, institutional selling pressure kicked in and drove the price back down. It happened repeatedly over several years, and it trained a generation of retail investors to think of $2,085 as a ceiling that simply could not be broken. But it was broken, and once it broke, the laws of technical analysis kicked in. Former resistance becomes new support. That $2,085 level is now a macro foundation, a distant floor far below where gold is currently trading. We are not living in the $2,085 world anymore. We are living in a completely different market structure, and the investors who understand that are the ones who will be best positioned for what comes next. So why is gold still elevated? Why isn't it falling? To answer that properly, we have to walk through three major macro events that have dominated financial markets recently. And I want to be very precise about the data here, because accuracy matters. The first major event is the most recent U.S. Consumer Price Index report. The Bureau of Labor Statistics released the May 2026 CPI data, and the headline number came in at 4.2% year over year, the highest reading since April 2023. On a monthly basis, prices rose 0.5%, following a 0.6% rise in April. That marks 3 consecutive months of accelerating headline inflation. Now, the primary driver of this surge is energy. Energy costs jumped 23.5% on an annual basis, with gasoline prices absolutely skyrocketing by 40.5% compared to 1 year ago. Fuel oil is up 58.9%. Shelter costs rose 3.4%. Food inflation climbed to 3.1%. Even the core inflation rate, which strips out food and energy to give a cleaner read on underlying price pressure, came in at 2.9% annually, a new recent high. Now, here is where it gets interesting. Under standard economic theory, when you see inflation running this hot, the Federal Reserve is supposed to tighten monetary policy aggressively. Higher interest rates make U.S. Treasury bonds more attractive. They start yielding guaranteed returns in the 4, 5, even 6% range. And when risk-free government bonds are paying out those kinds of returns, big institutional money traditionally rotates out of gold, because gold pays zero dividends, zero interest, zero yield. On top of that, a hawkish Federal Reserve typically strengthens the U.S. dollar index, which makes gold more expensive for foreign buyers and suppresses international demand. In theory, this inflation print should have been terrible news for gold. In theory. But gold did not collapse. Gold did not even flinch. And the reason for that comes down to something much bigger than the Federal Reserve's next meeting. The second major macro factor is the U.S. labor market, and the jobs data coming out of Washington has been remarkably resilient. A strong jobs print under normal circumstances would be another bearish signal for gold. It suggests the economy is healthy, that the Fed has room to keep rates elevated for longer, and that investors don't need the safety of hard assets. Markets are currently pricing in a 68 to 70% probability of a Federal Reserve rate hike in September 2026, according to CME FedWatch data. Bank of America's economists have gone even further, forecasting up to 75 basis points of additional tightening spread across September, October, and December. New Fed chair. Kevin Warsh has made it abundantly clear that he is not afraid to hike rates if inflation data demands it. The dot plot from the latest FOMC meeting showed 9 out of 18 committee members projecting at least one rate hike before the end of this year. Again, by the old rulebook, this is a death sentence for gold. Strong jobs, hawkish Fed, rising rates, stronger dollar. Gold should be at $2,500. It should be at $3,000 at best. And yet here it sits, near $4,000, barely reacting to data that would have absolutely destroyed it 5 years ago. So what has changed? What is the invisible force propping this market up despite every classical headwind? The answer is the G7 summit and what it represents on a geopolitical level. The decisions made by G7 nations regarding aggressive trade tariffs, supply chain decoupling, and the continued weaponization of the global financial system through swift exclusions and asset freezes have sent one unmistakable message to the rest of the world. Your paper assets are not safe. If the political winds shift, your foreign reserves can be frozen overnight. This is not a hypothetical fear. It already happened. When Russian central bank assets were frozen in 2022, roughly $300 billion in reserves seized with the stroke of a pen, every central bank on the planet outside of the Western Alliance had to ask itself a terrifying question. Could this happen to us? The answer, for many of them, was yes. And the strategic response has been enormous. Eastern central banks, BRICS-aligned nations, and sovereign wealth funds across Asia, the Middle East, and Africa have been systematically reducing their exposure to U.S. dollar-denominated paper assets and converting their foreign reserves into physical gold, the one asset that cannot be sanctioned, cannot be frozen, cannot be digitally seized, and carries zero counterparty risk. China alone imported 317 tons of gold in the first quarter of 2026, nearly 3 times the pace of the previous quarter, according to J.P. Morgan Commodities Research. The People's Bank of China ramped up its reported monthly purchases from roughly 1 ton per month to 5 tons in March and 8 tons in April 2026. This is not casual portfolio diversification. This is a long-term, strategically funded, sovereign-level defense mechanism. And it is creating a floor under the gold market that monetary policy alone simply cannot break through. Central bank buying from 2021 through 2025 averaged roughly 225 tons per quarter, approximately double the pace from the previous 5-year period, while Q1 2026 saw some reported selling from countries like Turkey. Unreported purchases and the sharp reacceleration from China suggest that the structural demand story remains firmly intact. The World Gold Council has noted that a significant portion of central bank gold purchases go unreported, which means the official numbers likely understate the true scale of sovereign accumulation happening globally. Now, let's zoom out to the bigger picture, because understanding the short-term price action is only half the story. The more important question is where gold is headed over the next 12 to 24 months. And for that, we turn to some of the most respected research institutions on the planet. J.P. Morgan Global Research has published a forecast projecting gold to average $6,000 per ounce by the final quarter of 2026, rising towards $6,300 per ounce by the end of 2027. To understand why a major institution like J.P. Morgan is making that kind of call, you have to look at the structural factors they are modeling. The U.S. national debt continues to expand at an exponential rate, with annual interest expense now representing one of the largest line items in the entire federal budget. The math, as many economists will tell you privately, is simply not sustainable over the long term. The 2 realistic paths forward for global central banks are to allow inflation to run hotter than official targets for an extended period, or to artificially suppress real yields through some form of financial repression. Both of those outcomes are historically very bullish for gold. Meanwhile, the 200-day moving average for gold is sitting around $4,140 per ounce. The 50-day moving average is near $4,730. Gold is currently consolidating between those 2 levels, what traders call a technical no man's land. But consolidation inside a secular bull market is not a warning sign. It is a normal, healthy pause before the next leg higher. Every major bull run in gold's history has included extended periods of sideways consolidation, and every one of those consolidation periods eventually resolved to the upside when the structural drivers reasserted themselves. There is also the question of the Iran conflict and its impact on energy markets. The ongoing geopolitical situation involving Iran has been a key driver of the energy inflation we discussed earlier. The Strait of Hormuz is one of the most critical choke points for global oil supply, and any disruption there sends shockwaves through energy markets worldwide. Higher energy prices mean higher transportation costs, higher manufacturing costs, higher consumer prices, all of which feeds directly into the inflation narrative that historically benefits gold. And while there are ongoing diplomatic negotiations that markets are watching closely, geopolitical risk by its very nature is unpredictable, and uncertainty is gold's oldest and most reliable friend. Now, I want to pause here for just a moment, because what I am about to share touches on investment positioning, and I think it is important that I remind you, I'm not a licensed financial advisor, and nothing in this video is personal financial advice. I am giving you the same macro context that professional analysts use to inform their own thinking. What you do with that information is entirely your decision, and I strongly encourage you to speak with a qualified financial professional before taking any action. With that said, let's talk about what the smart money is actually doing right now. So let me bring all of this together for you because I want to make sure the key takeaway is crystal clear. We are living through a period in which the traditional inverse relationship between interest rates and gold has been fundamentally disrupted. The old formula, higher rates mean lower gold, was built on a world where the US dollar was unchallenged as the global reserve currency, where geopolitical risk was manageable and contained, and where the global financial architecture was stable and trusted by all major participants. That world no longer exists. We are now in a world where sovereign nations are actively hedging against the US financial system itself, where central banks are buying gold, not because they think inflation will be transitory, but because they're preparing for a multi-decade shift in the global monetary order, where physical gold has become not just a commodity or an inflation hedge, but a strategic national asset. For the everyday investor watching this video, the strategic implications are straightforward. The 2085 level is ancient history. The market has structurally repriced gold into a new range, and the long-term forces driving that repricing, de-dollarization, sovereign accumulation, persistent inflation, unsustainable debt levels, and geopolitical fragmentation, are not going away next quarter or next year. These are decade-long structural trends, and the investors who recognize that now, rather than waiting for mainstream financial media to validate it for them, will be the ones who look back on this period as a historic opportunity. With JP Morgan projecting $6,000 by Q4 2026, with central banks buying at historically elevated rates, with inflation running at its highest level since 2023, and with geopolitical fragmentation accelerating the global pivot away from dollar-denominated assets, the structural case for gold has never been more compelling or more supported by real-world data. This is John Ag Briefing, and I want to hear from you. How are you currently positioned in gold? Are you holding physical bullion in private or vault storage? Are you using gold ETFs for flexible, liquid exposure? Have you explored a gold IRA for your retirement portfolio? Or are you still on the sidelines, watching and evaluating before making a move? Drop your thoughts in the comments section below. I read every single comment, and your questions and perspectives genuinely shape the content I create for this channel. If today's breakdown gave you clarity, gave you context, or gave you even one piece of information you didn't have before, please hit the like button. It costs you nothing, and it helps this content reach more people who need to hear this information. Subscribe to John Ag Briefing if you haven't already, and turn on all notifications so you never miss a major market update. Final reminder, everything shared in this video is for educational and informational purposes only. No content here constitutes financial, investment, legal, or tax advice. Past market performance is not indicative of future results. Always do your own research and consult a certified financial advisor before making any investment decisions. John Ag Briefing is an independent educational channel and is not affiliated with any financial institution, brokerage, or investment firm. Thank you for giving me your time and attention today. Stay informed, stay patient, stay strategic, and I will see you in the very next briefing.